Hey, everybody, and happy Friday. Hope you're having a phenomenal end to your week. Thank you for tuning in. Welcome to SRT Live with me, your host, Sean Richard. I'm over here at my office here at Guaranteed Rate and coming to you with some hot inflation data. I wanted to do this impromptu broadcast because we got CPI, Consumer Price Index, yesterday, and man, did it blow the doors off of inflation. Now that being said, it was right in line with where the market expected it to be, but we've got some additional inflationary fears moving forward, and we're going to talk about that for just a moment. So I want to go ahead and share this with you. Now, this isn't the most aesthetically pleasing data that I'm about to show you, but let me go ahead and pull this up. We're going to share. Boom. All right, welcome to. Can you see that? It's kind of small. Yeah, it's all right. I'm going to post the link in the comments below, so check it out. But basically, we got the CPI, Consumer Price Index. So right here, this comes out on a monthly basis, and this is an inflationary report. It measures inflation at the consumer level. If you've watched my videos before, you'll know I've talked about this in length. And so what I want to talk about today is, one, what's the numbers? What's the data that we just got yesterday? And number two, I want to talk about the impact on the economy. I want to talk about the impact on our housing market, and I want to talk about the impact on interest rates, because those are the things that we care about, right? We care about our economy, our budget, our spending, what we have the ability to spend. We care about our housing market. If you are a real estate agent, I want you to be able to articulate this information to your clients so that way you can help them understand what's going on our market and the pros and cons of going through the home buying or home selling process. So check this out. So hopefully you can see this. If you can blow this up maybe on your screen, but essentially the every month CPI comes out for the previous month. So we just got the report for February, and it was blazing hot. So this is, again, not super aesthetically pleasing data, but this is what we're going to look at real quick. So we've got here the month over month and ultimately the year over year 12-month rolling average for inflation for the CPI report. So inflation came in at 7.9. I don't know if you can see that here. Let me see if I can blow this up. Oh, check that out. All right. So CPI inflation came in at 7.9% increase year over year. Gang, I've been talking about this before. This is 40-year highs. Like, we haven't seen these kind of inflation numbers since 1982. I think in 1982, there was a month in there where we hit like 8.4. May hit that. So we'll talk about that in a minute, but 7.9%. This is massive. This is causing a huge spike in all kinds of goods and services. You've heard me say this before, but if you've been to the grocery store lately, you're seeing the price of items go up significantly, in even doubling in cost. So as a population, we are feeling this, right? You've got your average consumer that everything around them has been going up. The price of groceries, the price of gas, with everything that's going on in the Ukraine and Russia conflict. It's caused oil prices to surge. And we've seen that, we're feeling that at the pump. The price of gas is running $4 to $4.50 here in the DFW area. We're seeing even higher rates of cost of gas out on the West Coast. If you have family or friends out there, you've probably heard of $6-7 a gallon gas. So maybe we're we're okay with our $4 to $5 gallon of gas here, but we're feeling it on all angles. And so inflation is running red hot. Now let's kind of come down here. Well, actually, before we do that, so let's look at February. So here's February. So we saw an 0.8% increase in the month of February. And so this is a 12-month rolling average. So you can see all these percentages going back to August, and we've had really hot inflation since October, really. And so as we drop off some of these lower numbers, you see August of 21. If we went back and looked at the numbers prior to August of 21, you would see some lower inflationary numbers. So the challenge and where we're getting, where we're getting this 7.9% is as we're dropping off those lower numbers in our 12-month rolling average, we're now averaging in these much higher figures, 0.9, 0.7, 0.6, 0.6. I can do this. 0.6, 0.6, 0.8. So we're averaging in these higher numbers, and it's causing inflation, the reading to go through the roof. Now, here is a bit of the kind of scary part about inflation. The beginning of March is really when we saw Russia invade Ukraine. And so these numbers, this February number right here, this doesn't include the spike that we saw in energy prices, oil and gas prices, starting at the very, very beginning of March. And so there's a good chance that we're going to see an exceptionally high report, come April for the month of March. There's a chance that we're going to see an exceptionally high report on inflation, and we're going to see the 7.9 number tick up even further. So why do we care about that? What does that mean? How does that impact different parts of our finances? So first, let me talk about the impact to mortgage rates. And so mortgage rates inflation is the enemy of mortgage rates. Inflation simply means that our dollars don't go as far, right? Our dollars can buy less. And so with mortgage rates are dictated by mortgage-backed securities or mortgage bonds, which is a finite fixed investable product. So you have institutional and retail investors investing in mortgage bonds. Well, those bonds are a fixed product with a fixed yield, a fixed rate of return on it. So imagine going to your bank and getting a certificate of deposit, a CD, and your bank says, okay, we're going to issue you a CD and we're going to pay you 2% on your money. Well, let's say that 60 days later, the bank says, hey, we've got brand new CDs, same length, let's call them a 12-month CD, same length, except we're now paying 3% on your money. Well, are you still excited about being in your CD at 2% return on your investment? You're not. And so excluding the fact that CDs have a penalty to break them, if you could, you would sell your CD and you'd go invest that same money into the new CD at the higher rate of return. And so that's what's happening with mortgage bonds and how inflation impacts it. Is mortgage bonds are a fixed product, a 30-year product that's investable that provides a fixed rate of return or a fixed yield. And so when inflation goes up, it causes new bonds to be issued at a higher yield because that's needed to attract investors. And so when that happens, the bonds that were issued at lower yields are typically sold because, again, why would you hold on to a bond at a lower yield when you can get a higher yield on your money? And so when mortgage bonds are sold at heavy volume, then you see the price of mortgage-backed securities come down, and that has an inverse relationship with interest rates. So interest rates rise. So that's why we're seeing interest rates rise so significantly, is because inflation is in prime focus for the market right now. We've heard the Fed talk about it. It's been in the news. The CPI report coming out yesterday accentuated that. So inflation impacts mortgage rates significantly. And because it's in focus right now, it's having a bigger impact than a lot of the other aspects that are going on, or a lot of the other events that are going on in the world. Even though the Ukraine-Russia conflict is having an impact, inflation is really the #1 focus and priority right now domestically. Now, what else does inflation mean? What else does inflation do? Is there anything good about inflation whatsoever? And the answer is yes, there is some good news about inflation, because money doesn't go as far, it also helps pull up the price or value of fixed assets. All right, so what's a fixed asset? Anybody guess? It's your house. Your house is a fixed asset. So with inflation running so hot, it's also part of the reason, among other reasons, it's also part of the reason that we're seeing home prices rise at such a significant clip. The cost, if your money doesn't go as far, that means somebody coming in to buy your home, if your home was worth $300,000 and now your money doesn't go as far, now it costs more dollars to buy that same house. Well, how does that get represented for a home? Well, it gets represented in a higher sales price, a higher value. And so inflation is pushing the home values up among the supply-demand dynamic that we see in our country right now. And I've talked at length about that, so I won't go into that on today's broadcast. But inflation does help homeowners and their value continuing to rise. So there is some benefits to inflation, but it definitely hurts a lot of other aspects of the economy. The Fed is going to be meeting next week, and they're going to be taking action, some monetary policy to try and combat inflation. They're looking to increase the Fed funds rate. I've talked about that before. If you don't know what the Fed funds rate is, leave comments below, or you can reach out to me at my number right down below in the video here. Boom, give me a call, shoot me a text. So the Fed is meeting, and they're going to be looking to increase the Fed funds rate to help combat inflation. The expectation is they're going to raise 0.25%, and there's a small chance that they could raise 0.5%, but it's more likely that they're going to raise 0.25% because of everything else going on. A pact was probably on the table until Russia invaded Ukraine, to be honest with you. So that's happening next week. Now, the other thing that I wanted to connect on real quick was, property values, and we're continuing to see them go up. The supply and demand dynamic is constant. It's going to be there for a while. We've got a shortage of inventory. There's nothing that's really going to impact that significantly. There's no mass amount of inventory that's going to come in the market. Demand is going to stay high. You've heard me talk about that before. And so essentially, we're going to be in a similar market to we're in right now for probably another several years. I've been telling people 3 to 5 or more years. There's some analysts out there that have said we're going to be in this market for 10 years. I hope not. I hope that we're not in this market for 10 years. I think if the Fed can get a handle on inflation, then that's going to help out significantly. As inflation starts to come down, obviously we're going to get some breathing room in consumer prices. We may see a little bit of improvement in mortgage rates from where they're at right now. Although, and even if inflation comes down a little bit, it's still running really, really hot. So we'll have to keep an eye on that. So pay attention to what the Fed does next week with the Fed funds rate. Let's pay attention to the CPI, or Consumer Price Index report, next month. I'm going to be bringing that to you on another update. And if you have any questions whatsoever, hit me up, leave comments below. Happy to help out. And if you're a homeowner, a home buyer, and you have questions about mortgages, financing, need some honest, good help, my team and I are here to make sure that we're taking amazing care of you. So please reach out. Have an incredible weekend, and thanks so much for tuning in.